Hi folks, Chuck Gibson from Financial Perspectives with July 2018's Charts on the Move. As we drudge through the summer and the markets muddle ahead on low volume, there's little that's really new or interesting, so I'm going to keep this video short. You can thank me later. Let's get to it. Let me get this part over with quickly. North American stock markets are rising. Sometimes it's easiest just to keep it simple, and that's the bottom line this month. Because the trend is still upward, short-term pullbacks are to be taken advantage of. Now, see how easy that was? Let's take a look at a few charts to confirm the statement. The first chart is that of the US Total Stock Market Index, the same one I've shown over the past few months' videos, so it should look familiar. As of the close of July, we sit just a cat's whiskers under the prior high made back in January. With 30 weeks of this consolidation under our belt, it's not too early to see a breakout here. If it does, it's a testament to how strong this bull market is, because it would be the shortest pullback for the major pullbacks that we've experienced from the 2009 bottom. I would prefer we pull back here into the rest of the summer and autumn, build up energy, and unleash a strong upward push into the end of the fourth quarter. Why? Any breakout, or breakdown too, here would be suspect, as the summer months of the market tend to drift around as the traders are in control. The real direction of the next move will be determined when the institutional investors come back from the Hamptons. Additionally, this year we have midterm elections in November, which has historically been a catalyst for the markets. If investors like the results, the markets move higher with a strong tailwind, as the year-end Christmas holiday season buying spree will likely materialize. If the results shake up politics, I would not be surprised if we revisit February's lows. I don't want to venture a guess on which will happen, but until something dramatically changes, the probabilities are we move higher. As you know by now, small cap stocks and technology are usually the main market drivers in both up and down markets. So let's check in with the small caps first and see how they look. As you can see, unlike the broader market, they formed a really small area of consolidation after January pullback, but instead of being stuck, they went on to make higher highs and higher lows. Notice how price is above both its longer-term support line and the 200-day moving averages. Other than this near-term divergence, market participants should be happy with the look of this chart and its potential for gains ahead. Flipping over to the proxy for the NASDAQ Technology Index QQQ, once again should look familiar, as it doesn't look very different than the small caps. That is, except for the fact it doesn't have negative divergence. Those looking for a reason to sell complain that most of the past few years' climbs in the NASDAQ was due to Facebook, Amazon, Apple, Microsoft, and Google. They see this as not normal and something to be leery of. While those 5 stocks made up a huge portion of the NASDAQ gain, it's actually very normal for a few companies to account for the majority of a market's annual gains. For example, from 1994 through 2014, the top 6 stocks in the S&P 500 accounted for an average of 33% of the index's gain in any year. The top 20 stocks, which is only 4% of the total companies in the index, accounted for an astounding 68% of the index's gain. This typically occurs during secular bull markets. There are other examples and across other indexes around the world, but the bottom line is it's not unusual or unnatural for a relatively small number of stocks to disproportionately carry the indexes higher. The other reason this occurs is due to most indexes being capitalization weighted, so the biggest stocks contribute a disproportionate share of the index's return. So, if you're afraid and looking for a reason to sell this market, this is not one. If you're still a disbeliever, another way to confirm is to look at the equal weighted index, as they do not overweight the biggest stocks and skew the index in the direction of a few. Instead, they level the playing field and give every stock in the index the exact same weighting in the returns calculation. Taking a look at the equal weighted NASDAQ index, as you can see, it looks very familiar to the total US stock market. It sits right on the cusp of breaking out higher out of the consolidation range it has been in since January's highs. Since the heavily tech-laden NASDAQ index is only a portion, albeit a large one, of the overall stock market, let's take a look at the equal-weighted S&P 500 index to see how a broader look at the US stock market looks. Like the NASDAQ, this index too gives equal weighting to every stock, reducing the impact of the performance of the larger and/or best-performing stocks. In this case, each stock represents only 0.2% of the overall return of the index. As you can see last week, it closed out at the second highest level in its history and is nearing a breakout. No matter how badly the bears complain and warn of a crash, nothing, well, at least of yet, is remotely bearish or indicative of a top and or an end to this bull market. A topic I rarely ever talk about, but is one of, if not the most important aspects of investing, is psychology. The main reason I don't spend much time is because there are few charts or other graphics, so the subject doesn't lend well to video. The other is I am by no means an expert in this area, but I have learned a few things, not only by reading to get my CMT credential, but also making the exact same mistakes. It's very rare to be immune to the emotions investing can emote. I had Dr. Phil scheduled to give this section of the video in an attempt to make it more interesting and compelling, but unfortunately, he was a no-show. To borrow a concept from Yogi Berra, investing is 50% process and hard work, while the remaining 90% is mental. All kidding aside, if you can't handle the mental aspect, you'll be doomed to forever fail. And when it comes to failing, confirmation bias is among the biggest of all the mental challenges and behavioral biases investors need to master if they want to succeed. What is confirmation bias? When presented with information that favors a specific position, human beings find it almost impossible to consider an alternative idea. It has to do with the way our brains process information. We only consider the options in front of us. We don't go off searching for other options. In dealing with hundreds of investors like I do on a daily basis, it's amazing to me there are some who feel the market is on a precipice of a crash. But as you dig deeper, you find out these are the same investors who hang out and get their information on Zero Hedge, Business Insider, or less reliable sources. Add to that, they tend to only follow noted perma-bears and fearmongers. I'm not going to name those names, but you know the ones I'm referring to. I had one client call me worrying about that they read it in that notable investing literary powerhouse, USA Today, about the pending demise of stocks. Of course, it turned out the author of that article was the same expert who wrote about the perils of bunion surgery. Neither subject was he trained or had experience to write about. I had another client who just got back from a trip outside of the country and called me as she was wondering if we should cash in her account because the cab driver she had taken from the airport, I'm not talking about the one in the US, advised of a pending market crash. As it turns out, both people are very risk averse, afraid of every market gyration, and as such are open to any, even if it's from less credible sources, opinion that matches their belief. In real life, confirmation bias is generally fine, but in the fictional world of investing, it's dangerous because to be the best investors we have to consider and never stop considering the possibility that our favored investment ideas may not actually be as perfect as we thought. That's why I always have a plan B in case I'm wrong. Ye gad, blasphemy, you say? Unfortunately, confirmation bias drives us to look for information that supports our ideas and ignores the data that undermines them. That's it for this month's video. To close out, I want to reiterate my simple open to this video. The trend is still up and short-term pullbacks are to be taken advantage of. But, of course, that doesn't mean we should be investing with reckless abandon. There are few things that make me more nervous than a market that refuses to rally on good news. And the spate of good news earnings should have been enough to lift us to new highs, but it has not, at least of yet. If this continues, then eventually the next round of bad news will knock us down. As such, longer-term investors should be prepared to weather a little near-term weakness, while short-term traders should consider tightening stops and or locking in profits. I still expect good things over the medium and long term, but I have less conviction over the near term. Until next month, I always appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with July 2018's Charts on the Move.